A major corporation mailed one of its own employees a shopping flyer. Not health insurance, not retirement, a television, a refrigerator, a bicycle. Each one advertised with a small payment that could disappear from a future paycheck. The numbers looked harmless until we multiplied them. That is when the benefit stopped looking like a benefit. Because when your employer introduces a store, verifies your employment, and lets the payment come directly out of your wages, you are no longer only the worker. You have become the customer too. And the most important number is not the payment they printed in large type. It is the total they expect you to surrender before the deductions finally stop. This is not one company's secret. Employer-sponsored purchase programs openly sell electronics, furniture, appliances, tires, travel, and other products through payroll deductions. They are offered through hundreds of large organizations and marketed as voluntary workplace benefits. If you want more of the workplace offers that quietly change what you pay, subscribe to They Keep You Broke. We will keep pulling the systems hidden inside employee benefits into the light. The pitch is powerful. No credit check, no late fee, no interest. Your employment can determine whether you qualify, and the payment arrives automatically from your paycheck. One provider says the quiet part clearly. It is not a discount program. Some prices are higher than prices at large retailers. It does not charge interest because the program costs are built into the prices of the products. Read that again. The financing cost did not necessarily disappear. It may have moved into the sticker price. That distinction matters because zero interest answers only one question. It does not tell you whether the television costs $700 everywhere else and $900 inside the employee portal. It does not tell you whether a warranty was added, whether shipping is separate, or whether the paycheck number was chosen because it feels smaller than the total. Here is the rule that breaks the spell. Take the deduction per paycheck. Multiply it by the exact number of deductions. Add taxes, shipping, and every required extra. That is the payroll price. Then search the exact model number somewhere your employer did not send you. Compare the delivered price, the return policy, and a genuinely comparable warranty. Do not compare payment with payment. Compare total with total. Because $34 does not sound like a refrigerator. $34 every 2 weeks for a year is $884 before anything else is added. The payment is a feeling. The multiplication is the price. Now look at why this sales channel is valuable. The vendor may be a separate company. Your employer may not own it, lend the money, or receive a commission. We should not invent a relationship we cannot prove. But the employer still opened the door. The offer arrives beside real benefits. Eligibility can depend on your salary and how long you have worked there. The vendor can connect to payroll. The deduction is automatic, and the company presenting the offer already has something an ordinary store has to earn from you: trust. One provider tells workers, "Your job is your credit." Another says employee spending limits average roughly 7 to 9% of salary. Think about the reversal. Your job is supposed to be the source of your buying power. Inside this system, the job can also become the underwriting, the marketing channel, and the collection mechanism. That does not make every purchase a trap. A worker with broken appliances and damaged credit may rationally choose a fixed total over a payday loan, rent-to-own contract, or high-interest card. A bundled warranty may have real value. Predictable deductions may prevent late fees. The honest question is not whether the program is always bad. The honest question is whether the employer's label made you stop shopping. Because employee benefit sounds negotiated on your behalf. It sounds cheaper. It sounds protected. But a voluntary benefit can simply mean that your employer allowed a private company into the benefits portal at no direct cost to the employer. The seller still has to make money, and the person paying is still you. There is another workplace product built on the same payroll advantage, although it is not the same transaction. Earned wage access lets workers receive some wages before the normal payday. The merchandise program sells you a product. Earned wage access moves forward money you have already earned. Do not confuse the two. But watch what happens when both are attached to payroll. The Consumer Financial Protection Bureau studied 8 employer-partnered earned wage providers. It estimated that more than 7 million workers accessed about $22.8 billion through these products in 2022. The average transaction was only $106. The average worker used the product 27 times in a year. When employers did not cover the cost, around 90% of workers paid at least one fee. Nearly all consumer-paid fee revenue came from expedited transfers, the payment for receiving your own earned wages quickly instead of waiting. Using the average transaction, fee, and repayment timing, the Bureau calculated an illustrative annual percentage rate of 109.5%. That does not mean every worker signed a loan advertising that rate. It means a fee that looks tiny can become enormous when measured against a small amount of money for only a few days. $3 does not feel like debt. $3 paid again and again because payday is still 5 days away becomes a business model. And payroll integration makes repayment unusually reliable. The provider does not have to hope you remember. It can be repaid through the next paycheck. That lowers losses and makes the workplace relationship commercially valuable. So now the paycheck can carry 2 invitations: buy the refrigerator from future checks, or pay a fee to pull part of a future check into today. One sells against wages you expect to receive. The other charges for timing on wages you already earned. Both can feel painless because the transaction happens before the remaining pay reaches your checking account. This is the moment to check your own pay stub. If you have a voluntary deduction for merchandise, wage access, a payroll card, or another workplace financial product, tell us what category it is in the comments, without naming your employer or sharing personal information. People need to see how common this channel has become. And understand one more thing: appearing on a pay stub does not make a purchase tax-advantaged. Federal tax law recognizes specific qualified benefits, including certain health, dependent care, adoption, life insurance, and health savings benefits. A television does not become pre-tax because its payment is removed by payroll. It is still your money purchasing a consumer product. The deduction may be voluntary and legal. Federal law restricts certain deductions that cut covered workers below minimum wage or interfere with overtime, while state authorization rules vary. But legality is not the whole standard. A transaction can be legal, disclosed, and still be expensive. Your protection is not outrage. It is a checklist. First, demand the total price, not only the deduction. Second, compare the exact model number with at least 2 ordinary retailers. Third, separate the product price from warranties, shipping, taxes, and accessories. Decide whether those extras are valuable to you, not merely present. Fourth, ask what happens if you leave the job, take unpaid leave, return the item, or want to pay early. Fifth, check whether the deduction is after tax, whether it can be stopped, and how the authorization appears on your pay stub. For earned wage access, find the free transfer option before paying for speed. Ask whether your employer subsidizes fees. Add up what you paid over the last 3 months. If the service has become part of every pay cycle, the problem is no longer one emergency. The fee has become a subscription to your own timing shortage. And if you need the purchase today, compare it honestly with the alternatives available to you. Sometimes the payroll option may be the least damaging choice. That is not the same as calling it cheap. The old company store paid workers and sold goods back to them. Today's payroll programs are not automatically the same arrangement. The employer may only be the doorway and participation may be voluntary. But the echo is worth hearing. The company controls when wages arrive. A workplace vendor sells convenience against those wages. Then payroll makes sure the payment gets collected before the worker decides what the rest of the check must cover. You were not foolish for trusting an offer that arrived dressed like a benefit. The presentation was designed to feel safer than a store and smaller than a debt. Now you know the question that changes it. Not, can I afford $34 from my paycheck? Ask, what is the total price, and what would I pay if my employer had never shown this to me? Subscribe to They Keep You Broke, then watch the credit score episode next. It shows how another number about you becomes a price charged to you. And get the free Life Under Pressure kit at theykeepyoubroke.com. So the next friendly payment offer has to survive your math before it reaches your money. Your employer may sign your paycheck. That does not give every company inside the benefits portal permission to spend it for you. Educational content only, not financial or legal advice. Sources and dates are in the description.